Today we're going to analyze Alphabet stock and see whether right now is a good time to invest in the company for the long term. First, let's see if there's a good business behind the stock. Alphabet is projected to grow its earnings 19% per year over the next 5 years, while the S&P 500 companies are expected to do 17% over that same period. 4 points for Alphabet and 4 points for the S&P 500. Alphabet has a faster growing business. When it comes to profit margins, Alphabet gets 24% out of its business, while the S&P 500 gets 18% out of its 500 companies. 3 points for Alphabet and 2 points for the market. Alphabet gets more out of its business. I like companies that pay out a dividend. Dividends are the only thing separating a true investment from pure speculation. Alphabet doesn't pay out a dividend, while an S&P 500 ETF pays a 1.29% dividend. 0 points for Alphabet and 3 points for the S&P 500. As it relates to the dividend, we want to know how much is being paid out to shareholders. Alphabet has a payout ratio of 0%, while the S&P 500 is at 22%. 5 points for Alphabet and 3 points for the market. Alphabet is keeping all of its money to reinvest and grow. Cash and cash equivalents is a basic measure of cash available for payouts, reinvestments, and acquisitions. Alphabet has a $119 billion in cash available for those activities, while the companies that make up the S&P 500 have an average of $74 billion. 5 points for Alphabet and 4 points for the S&P 500. This metric benefits larger companies since they often command a higher economic value. Effectiveness is basically when you add the returns on assets, equity, and invested capital. Alphabet has an effectiveness of 70%, while the S&P 500 is at 58%. 4 points for Alphabet and 3 points for the S&P 500. Alphabet has a more effective business. How good is an investment if it never goes up? Looking at the past 10 years, Alphabet has returned a compounded annual growth rate of 18%, while the S&P 500 has compounded at 12%. 5 points for Alphabet and 4 points for the S&P 500. Alphabet is a better performing stock over those 10 years. I look at the PE ratio as a measure of speculation. When it's high, there's more people speculating on the stock. Alphabet has a PE ratio of 25, while the S&P 500 is at 23. 3 points for Alphabet and 3 points for the S&P 500. More investors are speculating on Alphabet. The PEG ratio takes into account the expected growth with the PE ratio. A PEG ratio under 1 is what we want. Alphabet has a PEG ratio of 1.3, while the S&P 500 is at 3.06. 3 points for Alphabet and 0 points for the market. Alphabet is a better value right now. The quick ratio tells us if the company can pay off its short-term obligations. A quick ratio over 1 means it can easily pay those obligations. Alphabet has a quick ratio of 2.1, while the 500 companies of the S&P is at 1.68. 4 points for Alphabet and 3 points for the S&P 500. Alphabet is more likely to pay its short-term obligations relative to its debt. While many investors look for a higher 200-day simple moving average, I look for one that's lower because it means more value. Alphabet has an SMA 200 of 12.2%, while the S&P 500 has an SMA 200 of 12.9%. 2 points for Alphabet and 2 points for the market. Alphabet's stock is lower than the market. Short float tells us how much are investors betting against the stock. Alphabet is short 0.9%, while the S&P 500 is short 1.08%. 5 points for Alphabet and 4 points for the S&P 500. Investors are betting more heavily against the market. The average Wall Street grade from a strong buy at 1 to a strong sell at 5. Alphabet has a rating of 1.55, while the S&P 500 has a rating of 1.68. 4 points for Alphabet and 4 points for the market. Wall Street is more bullish on Alphabet. This last metric is income divided by the number of employees. Alphabet's employees each have a value of $404,000, while the average of the S&P 500 is $305,000. 5 points for Alphabet and 4 points for the S&P 500. Alphabet employees produce much greater value for the company. Adding everything together, Alphabet has 52 points and the S&P 500 has 43 points. Divide each by the maximum of 70 points, Alphabet has a good business with a grade of 74.3, compared with the S&P 500 at 61.4. Both have good businesses behind the stock. Alphabet is just better. Before we get to Alphabet's final grade, join my Patreon and get access to every company I've analyzed so you can compare between all your favorite stocks. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. But of course we can't forget about Alphabet's fair price and whether it's the right time to buy its stock. I use a discounted cash flow model taking into account a 10% margin of safety. That translates into a fair price of $126 for Alphabet, which is 16% below its current stock price. When we look at the table, we can see that Alphabet's stock is overvalued, giving us 20 points. So if you're only concerned about the stock, wait until it drops by a lot. Finally, we can put everything together and get Alphabet's final grade. With a business grade of 74.3 and a fair price grade of 20, Alphabet has a final grade of 68.9. That means Alphabet is a good long-term investment if you were to buy the stock right now. However, I'd hold off until the stock gets cheaper before jumping in. So what are your thoughts? Are you going to invest in Alphabet? If you do, invest wisely. And as always, take care of your money.